Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And yes, of course, we are talking with the one and only Mr. Dan Bird. I get questions every Sunday. I hope you and Dan talk. I hope you and Dan talk. So yes, he is back. He's every Sunday.
What do they want us
Yep.
to talk about?
Well, they just want to make sure, dude. The stock market's going ape. I was gonna swear, just going crazy. And they want to make sure that somebody they getting to know yourself and trust that they get to hear about before the market opens.
Okay.
And I think that's a sign that you are an amazing communicator. Again, your ability to take complex things is and make it simple is awesome, and you're consistent, right? You are showing things over time, and we have a playlist. They can go back and watch these charts we look at evolve. So
Hmm.
that's why I knew this was going to work when I asked you to do this, and you said yes. I was just amazed. So again, people count on our Sunday conversations. So thank you.
It's just data. At the end of the day, it's just data, right? So it's interpreting the data, and a lot of times it's backwards looking, but it can also, history can kind of give you a guide for what's coming as well. So
Yeah. So I want to do something right up front. I think the last 3 months or so, I've taken victory laps on you because CPI came in higher, right? We were on the opposite side. We were once again on the opposite side. You had painted a vision where you thought we could get into the sevens, and it was. So I was wrong. You were right. Let's talk about CPI because I think there's a couple of little things in that number that maybe it's not as good as we like. But again, you are right. The number came in sub 8. Congratulations. Awesome.
yeah, thanks. Yeah, it's still high.
Exactly. We're
That's the thing,
celebrating 7-7.
right?
Yay.
It's still a high number,
Oh, that's funny.
but it means some of the things the Fed is doing is probably working. I don't think we can really say yet. I think it will work, but I don't think the evidence of that working is apparent yet. And I
Yeah,
and
the
I
big
said that all along. I've said it's 6 to 12 months before you're going to see the results of what they're doing.
yeah,
So,
the question I knew I wanted to ask you um was the market, the stock market, the indices, the Dow, the S&P
mhm.
and Nasdaq all had great. Thursday was an amazing day. I believe with follow through on Friday. But also the bond market. So the bond market fell 60 basis points. 6-0. When the CPI came out, I said it'd go down 50. It came down 60. I have never seen that, and I've been looking for 30 years. So the question I have for you is which is an overreaction? I mean, because both of these moves are so standard deviations above normal. Where's the reversion to the mean that you keep teaching us?
Well, we'll look at charts, but certainly Thursday was a big overreaction or a big reaction, let's say. I'm not sure it was an overreaction. It was pent up. It was like a loaded spring
Yeah, coiled
ready
spring. Yeah.
ready to pop, and it popped.
Yeah,
Um,
I want to ask you this. This is so I had a lot of people go one of two things. All clear, the Fed's winning, we're off to the races, risk on. And the second one was, hey, this is just a classic bear market rally and we're coming back. I actually think there's a third scenario that no one's talking about. So I don't know if there's any data for this, but I want to share my opinion that I talked about and wrote about. I actually think what happened is a lot of people got conditioned to CPI to print high. Like I thought. I thought we just have a fourth month of CPI coming in high. We're not going to see sevens. Why do all these stock people think it's going to be in the sevens? And I think there was a lot of people positioned either directly short or with puts, right? Because they were just ready for the next leg down. And when you have everybody betting on one side, it was the most popular trade. It was. Everybody was negative. You've shown us the data. And when it was positive, it just unwound and kept unwounding and unwounding. People were getting out of shorts. They were it's I think it was nothing more than most people were on the wrong side of the trade and they got out. I don't know if you can look at that, but that was my thought.
yeah, we'll look at some charts, and we'll look at some things might be related to that. I think it was a combination of both of those first two scenarios that you mentioned. And then your analysis, I mean, I think kind of supports the first two and both of those positions. Number one, risk on, all clear, we're heading higher, no looking back, let's go, jump in. And the other one was, I'm on the wrong side. I've been short for so long. And oh my God, that's the wrong place to be. So I got to cover my shorts, which means they have to buy, right? So you've got a bunch of people buying because they think we're heading back to the highs. And you got a bunch of people that were on the wrong side that have to get out of their positions, which means they have to short. I mean, they have to buy. Yeah. To close their short positions, they have to buy. So you've got both of those things happening on Thursday.
Yeah, well, I look forward to looking at your charts. You know, you've been showing us some starts about different segments of the market. I'm guessing the tech sector kind of has a very sharp right turn or left turn in it going up again. But I'd love to see how the charts, because Thursday, you know, we're talking 6% moves. That was a crazy day. So I'd love to see how the charts ended up looking.
It was one of the biggest days for the NASDAQ ever in history.
Yeah.
So let's take a look. You can see my screen, right?
I can. Yep.
So just in general, let's look at everything, all the sectors.
Okay. What do you got?
Let's see. Maybe I can make this a little bigger. How's that?
Yep. Perfect. Thank you.
All right. So we got the Dow, the NASDAQ, and the S&P on the top. And you can see the Dow had already started rallying. So the Dow was already in rally mode. The NASDAQ, here's Thursday and here's Friday, these two.
Look at that. Look at that gap open.
Yep, big gap open. Now gaps usually get filled, so keep that in mind. So big gap open, more importantly, above the 20-day and above the 50-day. So those are very, very important. You cannot have a sustained rally until you get above the 20-day and you have an uptrending 20-day moving average. So it's just starting to uptrend now. S&P is actually a little bit better because the 20-day has actually crossed the 50-day as of Friday. So that's really positive. Here's the 10-year Treasury.
Yeah, look
next
at that.
Next to the VIX.
Damn.
So big drop in the Treasury.
So let's just talk about this for folks, because the drop in the Treasury is just amazing. But I there's a story behind that. So when I look at the 10-year and I talk to all my mortgage folks and people in the business that move money, they're basically saying, A, that the Fed is winning, and B, more importantly, the Fed's, you know, there was talk on Wednesday, so pre-CPI, Dan, that the terminal rate might be as high as 6. What people are telling me now, you know, kind of into the weekend, is we no longer think it's 6. It might be 5.5. It might be 5. But what we're seeing is the terminal rate is coming down, and that obviously helps the debt markets, I think.
Yes. And if you'll remember, and you can go back and look at these videos, what I have always been saying, that it won't get above 5.
Yeah, I'm calling 5. I haven't changed my opinion. 5's the number. But
yeah. It could get to 5. I don't think it's going to get over 5.
I do not think so either. 5 is the number. Yep.
Because and that doesn't mean the Fed's going to stop. I think the Fed could still raise, probably will still raise 50 in December.
50 is a lock. 50 is a lock.
I'm not sure it's a lock, but we've got one more CPI number to come out.
Yeah, that's fair.
So we'll see what that one looks like. Could get a 6 handle.
Yeah, you're right. It's fair.
So I think it's probably 50, but I don't think it'll be higher than 50, and it could be lower.
Yeah, you're right. You're right. I agree. Above 50 is I think off the table. So if you're going to say what's the option, you're right. 25 is the other one. I agree.
Right.
Okay.
Yes, and then as they have always said, they want to get to a certain level, and they want to stay there for a long time.
Correct.
So that's really the key.
I agree.
They want to stay there for a long time, and for a long time could mean a full year that they stay
I'm
at
actually,
whatever.
just to be clear, I'm planning a year.
Yeah,
Absolutely. There are no rate cuts in 2023.
I don't agree with that, but that's what the
Understand.
Fed. That's the Fed's narrative. They're not going to back off that narrative because
Until
the
they're
narrative has an
forced.
effect. Even if they don't raise, the narrative itself has an effect.
Oh, they can't. Let's be clear. One of the reasons Joe Powell was so hawkish at that meeting is that's part of the game. It's
Right.
part of the game. He can't, he says one word about a potential pause in December. Let's just say he comes out next week. Somebody asks the questions. He gets quoted that, yeah, of course we'll consider a pause, even though he's like, that's a 1% probability. That will send the market bananas.
He won't say that.
Right. I'm just trying to say that him talking tough is part of the game.
That's right. And he'll repeat what he said before. He'll say, we're going to look at the data. We'll see what the data tells us. Looks like our policies are beginning to work, but we don't know that yet. We won't know until we have consistent, continual decreases in inflation.
Multiple data points, not
Consistent and
one.
continual
Yeah.
decreases in inflation, and he'll continue to say that.
Mhm.
So we had a good number last month. Last month was also lower than it had been. So you can go back and point to June as peak inflation.
Yeah,
At
there's
this,
definitely a trend. You can't argue the trend.
right.
Yeah. Yeah.
But he will continue to say we need to see inflation coming down consistently month after month for a period of time.
Mm-hmm.
So we would probably get another lower one in December, but that really will only be two lower ones, because even though last month was lower, it was higher than what they expected
Correct.
by a tenth of a point, but still.
Yeah. The
But
other
still,
chart, yeah, agreed. The other chart I want to mention, because again, we hit it last week. I hit it with Taylor, my Wall Street guy on Mondays, is the VIX. Look at all of this. You and the average investor, which I will not include you in, but I will certainly include myself in. The VIX is supposed to be a volatility index, and we have been going bananas in the market, and the VIX is going down. What the hell?
so remember what I said last week? We had this conversation last week.
I remember.
And I said, when the market went down right here the week before, the VIX also went down. Mm-hmm. And remember our conversation? I said, that is very rare. That's not supposed to happen.
Right.
And you said, well, what does that mean? Does that mean we're going up? And I said, I have no idea what it means. I don't
You are
know
honest.
what
Yeah. I don't know. It happens so unusual. I don't know what it means. Yeah.
I don't know what it means, but I do now.
Coiled
The,
spring, I guess, is what it means.
the VIX kept going down. The VIX was going down for a reason.
And it's still going down.
Now you could for those out there that hypothesize that there are nefarious things going on behind the scenes, you could say that somebody in the market knew that it was going to be a low CPI number. Mm-hmm. But I don't really think that's true. I think the market anticipates. It always anticipates. It's always anticipating the future. So, but it could have been wrong. So you can see a little bump in the VIX right here the day before the CPI number.
So you're teaching me about these charts. I just got to ask a question. Can you scroll down to the green and I'll call it red charts just for a sec?
Yeah.
So you've been teaching me a lot of things, right? I'm trying to learn. That's why we have these Sunday conversations. And I have to say, it feels like we might be getting to a top when I look at 90% of, stocks above, or is it 80? I guess it's 80% above their 50-day.
Right.
And it's kind of feeling stretched looking at those charts.
So that's a good observation. This is a percentage of stocks above their 50-day, the green one. Mm-hmm. And the red one is a percentage of stocks above their 200-day. And then the one below is a 10-year treasury yield. And you can see the channel that it's been in. Yeah. But yeah, that's something I noticed as well, that we're getting back near this rally, the August rally
bounds.
That we had.
Yeah, upper bound.
Right.
Yeah.
And then back here is the March rally right here. Mm-hmm. So yeah, it's getting near there. There's something else that's even more important, though, that this kind of points out. And I'll show you that in a second. But look at the put call ratio.
Yeah.
So here's what kind of what you were talking about before. Right here before the CPI number, when we had this downtrending market, and actually just 2 days before, the put call ratio spiked way up to 1.3.
And again, that's the sign that people are negative.
Yes. People are buying puts. When that goes up, that means more and more people are buying puts.
Said it in English for folks. People were expecting a bad CPI print.
They were positioned for it.
Position, okay. Position.
I'm not sure they were expecting it, but they were positioning themselves for it.
But because they
were, insurance is a good way to put it. Okay. So they're buying puts for insurance against their long positions. So yes, this is the coiled spring right here. All these
very
puts.
Cool. Very cool.
Right.
Okay.
So whenever this gets above this pink line right here, which is actually 0.8, that's the point where there are a lot of people that are selling or that are bearish, that are negative in the market. That's the time that the market will reverse dramatically and explosively, especially when it gets this high to 1.3. Now we can go back. This is just 8 months. So let's go back 3 years, just out of curiosity. Look at that. This goes all the way back to, this is the COVID.
Yep.
See the put call ratio right here?
Same number, 1.3. Look at that.
Same number. That's right. It actually was a little bit higher last week.
Okay. Wow.
All the way back to the COVID crash.
Damn, look at that. That puts it in perspective. How people were thinking the number would be, or insurance on a bad number. Wow, that's crazy.
Exactly.
That's eye-opening. I was right. People were negative.
And then you can see how fast they unwound that in 2 days.
Yeah.
This went all the way back down here.
And that's why go ahead.
Not only were they getting rid of their puts, they were buying calls.
Buying calls, exactly. They flipped a script.
Right. Yeah. Now, the other thing you can take from this chart right here is we can go all the way back to, after the COVID crash, sometime around June, when this big run right here, this big, huge rally that we had for a year and a half, right? After COVID, the market just kept going up and didn't look back. But look at the put call ratio. The put call ratio does get down there that low, but it doesn't stay that low for that long. This right here is sentiment. Sentiment was so bullish all the way through this period. There was nobody selling. Everybody was buying.
Free money, folks.
Money.
That's
it's an ATM
ballers.
Right.
ATM. It's gambling. Let's go to the moon, baby.
Exactly.
Nobody was scared. Nobody was scared.
That's right. And
wow, that's telling.
Right up until here, this is the beginning of this year, 22, where this just began to trend up. And you can see it actually went above the pink line right there briefly. So this whole year, this has been trending higher. But look where it is now.
Yep.
And then going to your observation of the percent of stocks above their 50-day, yeah, it's getting up there, but it's not as high as it has been. But it's getting there. So let's look at something else that actually, well, this is we're going to check in on this every so often. This is the long-term secular bull that I've talked about many times. How do we know when the secular bull is over? And it's when this goes below these green areas, or this goes below this red line, which is the 200-week moving average down here.
Okay.
All right. So we are still in a secular bull market. We came down and looked like it was going to breach that, but we've done that before. These 3 other times, right? And this has not gone below zero ever since the beginning of this back in 2011. So we are still in a secular bull market. This is still technically, this whole thing for almost this whole year is a cyclical bear market, short term. So we'll see, and you can see it's beginning to turn up here. This is a monthly chart, by the way, so it takes a long time for this to move. But you can see it's just barely beginning to curve back up. So, but the thing that I'm looking at is right here. This is a weekly chart for the S&P. Mm-hmm. So we hit the low down here at 3,500, which I've talked about this before. This is the 50% Fibonacci level. It's also the middle of the range from the high that we had at the end of 21 back to the COVID low. So those are the anchors for this whole thing. So this COVID low back here and the 2021 high. So this right here, 3,500 was the Fibonacci level, 50%. It's also the middle, the exact middle of this whole range, the exact middle. These blue lines are quad lines. So it's 1/4 of the move, each of these blue lines. So 3,500 is the exact middle. So we hit that, 3,491, a little below it, and then started to rally. But look where we are now. So for those folks that say this is just a bear market rally, and they're not wrong, of the last 14 bear markets, 13 of the biggest rallies, the biggest percentage rallies were in bear markets.
Yes.
All right. So technically, this is still a bear market rally. Okay. And it will continue to be a bear market rally until we see what happens right here, right in this circle that I have circled right there.
Yeah. So one of the big economic numbers we have next week, and you called this out in your newsletter, which we should show, is retail sales. And I think we're living in a world where good news is bad news and bad news is good news. What I mean by that is retail sales, I think month on month are expected to be up 0.9%. If it comes in horribly weak, the market will read that as what the Fed is doing is working. And then the rally could continue. If it comes in super high, I don't know, 1.5 or whatever it is, it'll be sign that the consumer is still strong and still spending, and the market will reverse. That's my thoughts. What do you think?
So what do you think it's going to come in at?
Well, check my logic. Check
higher or lower. No, I think you're probably right. It's only one data point, and the Fed looks at a lot more than just one data point.
No, I think right.
But I think it's going to come in. I think it's going to come in a little higher.
Yeah, that's where I
think it's going to be a little bit stronger than forecast.
Yeah, I think it'll be, if I had to pick a number, total wild ass guess, 1-1.
Yeah, could be. That's reasonable.
Yeah, that's where I'm at.
That's on Wednesday.
You want to have a lot of fun. Let's play Friday's existing home sales. This is obviously an area I look at a lot more than you. Look at that expectation. Right. Last month was 4.7. They're expecting 4.39. So that's the experts taking, what is that? 200,000, 300,000 off month. That's the year, or that's a annualized number. Do you think it comes in higher or lower than the expected number?
I think it's going to be lower.
Oh, it's going to be definitely lower. It's going to be, I'm thinking 4.23. It's going to be bad. It's going to be horrible bad.
Yeah.
But just so we're clear, we're heading by December. I'll call it right now. It'll have a 3 on it. It'll be 3 point something. We are going down.
Yeah, I don't disagree with that. I think that's very possible. By the way, my newsletter, which I usually do in the beginning of this, but if anyone's interested in getting my weekly newsletter, there's no charge for it. Just send me a note to breakpointtrading@gmail.com. I've had a few people ask me if I have a YouTube channel, and I'm probably going to do that at some point.
I get that a lot. That's awesome.
Because what that would allow me to do is to make some comments in the middle of the week. Like at Thursday, for instance, would have been an ideal time to talk about that huge run up. We're going to talk about this in the second session today. But I had a comment about the FTX fiasco.
Oh, okay.
We'll talk about that in the next one.
Very cool. Well, do me a favor, folks. You want to get on this? I get this every week and look forward to it. It's breakpointtrading@gmail.com.
Yeah, before we sign off, I just want to look at a couple more of the
Oh,
charts
I'm sorry.
here.
Go ahead.
This is the whole year, so that you can see the channel that we're in. You can see where we've hit this channel line 3 times before. And the 200-day moving average is really, 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 really important. It's at 4,100. I would not be surprised, and we're going to get a PPI number on Monday,
Monday
which will
morning.
probably also be lower. I would not be surprised if this rally continues, and I would not be surprised if we abruptly stop right there at the 200-day and reverse, come back down, maybe come back down as far as 3,900 again. That's for all the folks that say this is just a bear market rally. It's not going to last. That's where the bear market rally should end. That's where all 3 of these rallies ended. Right at the channel line, a little above the 200. This one ended right at the 200. I expect this one's going to end right at the 200. It might go a little bit beyond it, and then we're going to start coming back down again.
Okay.
So something to watch. This we just talked about. Here's the CPI numbers with the CRB index and gasoline down here.
Oh,
so gasoline's starting to roll over again.
Didn't know that.
And the market's starting to trend up again. Here's the Fed funds rate. So last time I made this dotted line here, assuming we're going to get 75, and we did. So right now we're at 3.83. So we're right there. This is the funds rate from back in 2004 leading up to the financial crisis. Yeah. It got to 5.25.
Yeah, I can't see us getting above that. I just can't.
No, we won't. If we get 50 in December, we'll be at 4.33. That'll put us right there. And then I think they're going to hold it there for a while. And in April, we might get another one. March, April timeframe. We might get another one that will put us maybe at 4.5, maybe 4.75.
Yeah, somewhere in there. That's where yeah, it's 4, 5. For me, it's between 4, 5, and 5. Yeah, I'll take 5 at currently.
Yeah, I think 5 is the highest we're going to go, and I think after the December one, the talk is going to be about deflation and recession.
I agree. I would just reverse the order, but yeah, I see what you're saying. Yeah.
Yeah. And as soon as that happens, as soon as the talk gets really serious about recession, you can see these little blue areas. This is the amount of time it took from the time the Fed stopped or started to cut rates till the recession happened. About 6 months. Okay. Cool. As soon as the talk starts turning towards recession in a serious way, and we start getting inventory reports saying it's too much inventory, retail companies start cutting their prices to get rid of inventory. The supply chain issues are beginning to be resolved already. The cost of containers is coming down dramatically. I showed that 2 weeks ago. When that starts happening, the Fed will probably get up to this 4.33, and they'll say, well, now let's see what's going to happen. And they won't do anything until April. April, they might raise again, but I think by April, the talk will be so focused on recession that the Fed will say, we are going to pause and we have to start thinking about rate cuts. So as soon as that recession happens, the Fed is going to start cutting. And this is kind of a long-term view of the 10-year and the 2-year. You can see, look at how the 10-year just dropped off a cliff last week.
Wow.
This is the 2020 recession right here. We had a yield inversion right there.
Yep.
Took about 6 months for the recession. We had the yield inversion right here. It's about the same place, actually. This was in August to October, and this one is in August to September. So 6 months would put the recession sometime in March or April. And That's what the talk will all be about before the Fed ever gets to that 2023 rate increase. I don't think they're going to get there. And then this dotted purple line of bonds, there's bonds right there. Bonds just took off as well.
Yeah.
I mentioned that a couple of weeks ago. I said, pay attention to bonds, because bonds could take off. I mean, they could really fly.
They had a very good Thursday.
Right.
Yeah. Very cool.
So,
all right. Well, let's show you.
All right, we're gonna talk about the FTX fiasco a little bit in the next session, and Bitcoin. We'll look at that.
Flash your newsletter, please.
Oh yeah. Newsletter. For those that are interested, just send me a note to breakpointtrading@gmail.com, and I'll send you this week's. These are some excerpts from this week's newsletter, and I put little cartoons in there. This one here we'll talk about in the next session. What to do with crypto. Sell at a loss or hold till zero. There's your choices.
Hold till zero. Thanks, buddy.